Good morning, everyone. Appreciate the kind introduction. As Chris said, I'm Adam Fleck, Director of Equity Research for Morningstar Australia and New Zealand, and I'm really pleased today to be welcoming three of our analysts. We have Brian Hahn, a Senior Analyst covering telecom, media, and leisure. Johannes Fall, Analyst on the end there, covering consumer and retail. And last but not least, of course, David Ellis, our Senior Analyst covering banks, insurance, and other diversified financials. And so today we're talking about disruption, how it impacts the companies we cover, and how it impacts the global landscape as we see it. I think it's fairly easy to look back and identify the most obvious impacts of disruption. I mean, we can all look in our pockets and our phones and think about what the world was like in the dark ages of the early 2000s before Apple came along with the iPhone. But it's one thing to look back and identify disruption when it's already happened. It's another thing entirely to see when it's currently happening, or even more importantly, when we think it's about to happen. And so what we're going to discuss today is how we as equity analysts and the companies that we're covering look at the potential impact of disruption, importantly on the sustainable competitive advantages of the businesses that we're looking at, as we call it the economic moat, and what we think is priced into the stock and how we value the company as based on our fair value estimate. And so our session today is going to last about 30 minutes of discussion. We have about 10 minutes at the end for Q&A, so please think of those questions that you might have for myself or our analysts. But kicking right off into it, Brian, you're right here. We'll start with you. Covering technology, I think that's probably the most natural place to look when we think about disruption. Let's maybe start with media, for instance. You think about the traditional platforms like TV networks and newspapers. How has potential disruption impacted those businesses, and how could continued potential disruption, if you think about digital, mobile, streaming services like Netflix, impact your view of the competitive landscape there?
Yeah, thanks, Adam. Look, I've been following the media sector for about 20 years now, and I do believe that it's one of the very first traditional sectors that has felt the full brunt of this digital disruption that you speak of, and it has completely dismantled the competitive landscape. Now, for example, and I just happen to have a slide here. For example, 7 years ago, that was only 7 years ago, TV, newspaper, and radio, their collective share of the Australian advertising pie was close to 80%. That was only 7 years ago. Last year, that was just over 40%. And you ask yourself, where did all that advertising go? And it went to internet and digital related advertising. So only 7 years ago, these digital advertising accounted for only 17% of the advertising pie. And now it accounts for about 48% and still increasing. And just to give you another example how this disruption has completely decimated the earnings power of these traditional media, only 3 years ago, the collective value of the free-to-air metropolitan TV licenses, they were valued at $3.6 billion only 3 years ago. Now, they're valued at less than $2 billion. And if you ask the young people who don't watch any free-to-air TV, they'll probably tell you that that's probably $2 billion too much. So that's how it has sort of changed the competitive landscape of the media industry.
Yeah, that's interesting. And I think we've seen some recent government reform in that regard as well. Has that helped? Is that going to help? What do you think is going to happen there?
This media reform, if anything, I think it entrenches my thinking that there is no economic moat around these traditional media business models. Now, if you allow one company to control newspapers, TV and radio in the same one market, I tell you what, that's not going to suddenly make people ditch Facebook, Google and Netflix and suddenly rediscover their love for Trading Post, Sydney Morning Herald and free-to-air television. I can assure you of that. What this media reform, if it does go through, what it does is it allows these challenged traditional media businesses to get bigger. And what that does is it allows them to amortize the rising content, editorial and production costs over a larger audience base, and hopefully give them some breathing space so that they can transition their business models to the new digital age and perhaps fight against the likes of Google and Facebook better.
But still no moat?
Still no moat. It's hard to see how they can sustain whatever return that they can generate right now in an age where, tomorrow, Facebook could be the next MySpace and some other book comes along and that completely dismantles it. So, yeah, it's hard to see how it can sustain a moat.
Yep. Let's shift gears a little bit and move to telecom. We've all seen, I'm sure, the announcement that TPG is planning to enter the Australian market as the fourth wireless carrier. You cover Telstra. What are the implications of that for Telstra, and how do you think about Telstra's moat and the barriers to entry as we see a fourth player come in?
Yeah, Adam, I don't think there's any beating around the bush on this issue. TPG's entry into the Australian mobile industry is going to be very disruptive, and it's going to be bad for the industry. It's going to be bad because instead of just 3 snouts in the $25 billion mobile revenue pool, there's going to be 4 snouts in the trough. It's going to be bad because it's going to drive the industry EBITDA margin down from the current 36% to most likely below 30%. And it's bad because that fourth operator just happens to be TPG Telecom. Without doubt, the most aggressive and price discount-led operator in the Australian telecom space. So that's the background. Having said that, I think it'll take TPG Telecom much more money and much more time to become a sustainable fourth player in the mobile market. Why? And I just happen to have another slide here. Because it simply does not have the spectrum that the 3 incumbents have. And the spectrum that it has in the low frequency, and in case you're not familiar with the technology, low frequency is actually good in telcos. It means the signal can travel past buildings, your own body, and gives you better coverage. It just simply does not have the spectrum like the other 3. It has far less mobile cell sites than the other 3. And its mobile coverage, 4G coverage, will be about 80% compared to 90% plus for the other 3 operators. And after spending $2 billion rolling out this inferior network, it'll probably have to spend minimum of $300 maintaining that network. And that $300 million pales in comparison to what the 3 incumbent operators spend maintaining their networks. So the point I'm trying to make is, yes, TPG Telecom has broken through the barrier of entry into the mobile industry, but I think it still has to deal with all the advantages and moat characteristics that Telstra enjoys in terms of efficient scale, cost advantages, and basically infrastructure footprint.
And then maybe I do want to make sure we get to our other panelists, but just a few comments on Vocus, which I know had some profit downgrades recently as well. Is that another example of disruption in this space?
I can tell you Vocus is, I used to have some hair, and Vocus has basically got rid of some of them. But let me tell you something. Vocus is not disruption related. Vocus, I believe, is mostly company specific. You have a situation where you have a company that's an amalgamation of 9 to 10 companies that's been put together in recent years through various mergers and acquisitions. And the resultant company is a company with hard to replicate infrastructure footprint right across Australia and New Zealand. And combined with its sales force, it has great potential to increase market share across all segments of the telecom space. The problem right now is you have all these companies that have not yet been integrated. And the systems, processes, and controls, they are just woefully inadequate. And timely information is just not flowing through to senior management. The analogy I have is this. You can imagine Vocus as a V8 car. It has the potential to go really fast. The problem is the driver's sitting there and he really doesn't know how fast it can go or what buttons to press to make this car go smoothly, because all the analytics and information coming in his ear from the pit stop people, they're jumbled, they're mangled, and they don't make any sense. And the latest profit warning sort of raising concerns about whether this driver himself really knows how to drive this car. But the point I'm trying to make, the car itself has the potential to go fast. And if they can figure out and integrate all these systems, processes, and controls, I do believe that the intrinsic value of this company could be twice what the current stock price is implying. But I must admit, the road to get to that intrinsic value, I think, will be a very rocky one.
Yep, fair point. David, let's maybe shift gears a little bit to continue Brian's very detailed analogy on cars and talk a little bit about financials. And you and I have talked about disruption in financials, and I think we've probably seen most recently in the budget proposals the government's attempt to disrupt the big banks. So how does that impact the major banks that you're covering, and particularly around their economic moats?
Sure. Well, just a quick recap on the budget and the regulatory disruption. It wasn't that long ago I thought digital disruption was one of the biggest key risks, but obviously following the budget, the government has decided to make a number of changes that impact the banks, most of them negative. There were some positives, but of course the bank levy was the biggest negative in my view. There was 3 or 4 other initiatives. The ACCC is being given extra powers to investigate bank pricing. APRA's being given extra powers in regulating certain aspects of banks' activities. There's a new ombudsman's been created. There's risks around that. So of those negatives, the bank levy I think is the biggest negative, and obviously has been very widely covered over the last week or so. It's had a big impact on bank share prices. The 5 banks that are affected prior to today's sell-off were down an average of about 4%, not including the NAB and Westpac going ex-div. That equates to about $20 billion in market cap, and if you apply our 13 times PE to the 1.5, 1.6 billion expected impact per year, that equates to about 20 billion. So 20 billion's been wiped off the market cap, primarily because of this initiative. There's some concern about and confusion and uncertainty about the initiative. Is it one-off? Is it likely that the government will come back to the well at some stage in the future? If we've seen what's happened overseas, that's a strong possibility. Is it a fee for the implicit government guarantee for the 4 major banks? Then is it just budget repair? Was it designed to buttress the government's or the sovereign's AAA rating? So there's a lot of issues around it. It's, on my estimates, if it's not recouped, it'll impact earnings and valuation and dividends by between 3 and 5%. So it's meaningful, but it's manageable. It's meaningful and manageable. And in my note I published last week, I said I think the banks will recoup it, maybe not 100%. So the most likely outcome I see is a partial recoupment where customers will bear some of the cost, shareholders will bear some of the cost, and bank staff will bear some of the cost with focus on cost reduction. So how does it affect our moat, our wide economic moats that we apply to the 4 major banks? Well, on my thesis that the banks will be able to recoup most of the impost, I see our wide moats are intact. But going forward, a lot depends on what happens over the next few years with the current government or future governments, whether they decide to increase the levy, which is it's happened, as I said earlier, overseas. The bank's pricing power may be curtailed by government initiatives, so I mentioned the ACCC. So the pricing power is what we see as underpins the bank's wide moats. So we'll have to wait and see how it unfolds. But at this stage, I expect the wide moats to, as I said, to remain intact.
So you mentioned another key potential disruption if you think about digital and fintech maybe more broadly. How do you think about the bank's ability to deal with upstarts, fintech, and even some of the big companies like Apple or Google or some of those?
Well, the banks are embracing technology change, and in a strange way, the banks are just big IT companies, and and this is nothing new. As long as I've been around the banking industry in Australia, the banks have been very innovative and adopted change and led change. And what we're seeing at the moment is the banks are investing in a range of ways. So it might be venture capital, it might be incubating small fintechs, it might be direct investments. So they're very active. They've in that regard. But I don't think the major banks are losing any sleep over the risks of small startup fintechs. I think the small startup fintechs need the banks more than the banks need the small startup fintechs. The banks have got the scale, the banks have got profitability, and the banks have got the customers. They're in a very powerful position. However, as you said, Adam, the larger global IT companies of the Apples and Googles of the world may pose a bigger threat to the major banks, particularly in certain segments. We're seeing a lot of competition in the payment segments. So we'll have to wait and see. The banks, as I said, the banks are spending a lot of money, a lot of time, a lot of effort in making sure that they're ahead of the game as far as these technological changes. But I'm quietly confident that they will be able to combat this threat in the long run.
So maybe that's a good segue. Maybe, Johannes, we can talk a little bit about the big disruptor that I think many of us expect to be coming soon, which is Amazon. And as a US expat, people ask me what I miss most, and I usually say Amazon Prime 2-day delivery. And I think they're coming, right, Johannes? And when you look across the sector, I know you published a report this morning on the impact to the electronics retailers in particular. You look at JB Hi-Fi, Harvey Norman. When you look at Amazon and what they're likely to do, is the US situation a good sort of comparison? And what do you think are the impacts there?
Yeah, so I guess Amazon is a bit of a complex beast in our view, in terms of there's two stories to Amazon. Firstly, it's a competitor in its own right in any given segment or category in which it operates. But it's also one of the best online pure players in the market. And I guess its growth and its size speaks for itself. So as Adam mentioned, we published this in-depth report this morning or yesterday. And I guess there's a lot of detail in there, but really what stood out to us is that, for instance, the US market, the growth of the online channel in the US market has been phenomenal. And funnily enough, Australia only lags the US by about 2 to 2.5 years on that trajectory. So we're just on that same path. So in our view, it's quite easy to predict probably at least the next 2 and 2.5 years forward. Amazon will come, in our view, probably in 1.5 years or so, and will accelerate that growth probably for a number of years. What that then means for the Australian retailers, and I guess Harvey Norman and JB Hi-Fi operate in a sector that has very high online penetration in Australia already, which means a lot of the goods that are sold in the Australian market are already sold online. And so it lends itself really to that disruption. Basically what we found is that Amazon, despite coming in and growing very strongly in Australia, most likely taking a lot of that incremental growth and a lot of the online market, there's still going to be a lot left in that online channel for JB Hi-Fi and Harvey Norman to pick up. So there's a lot more share up for grabs. We think Amazon will have about 1/3 of that sector under its thumb, and so that still leaves 2/3 for other players, just as Harvey Norman, JB Hi-Fi, and Kogan.com is probably another example. But essentially, what it means for the brick and mortar channel is, in our view, that it's going to stagnate. So that growth there is over in our view. The only way for JB Hi-Fi or a Harvey Norman to grow is really to consolidate that market, which we see happening. We've seen it happen already, and we think that's going to continue. But overall, the brick and mortar channel will continue to exist, but all the growth is gone. I think one other interesting point to make, and this is where we split out our view, the two stories I was talking about, online growth or Amazon as an online player, but then also as a competitor. If you look at who's competing with Amazon globally, and I think one name that stands out is Best Buy in the US. So it's a very large consumer electronics retailer in the US. Most of you are probably familiar with it. And what we find there is that Best Buy has been successfully competing with Amazon. So their online growth is in line with the market. Amazon's still outgrowing them, doing better, but Best Buy is actually growing their online segment significantly. It's a bricks and mortar which is going backwards and which is hurting the company. So we can see a similar, I guess, scenario playing out in Australia. And given that Harvey Norman and JB Hi-Fi sit even lower on the cost curve than Best Buy does in terms of their cost of doing business, we think they'll be successful in competing in the online channel with Amazon in Australia.
Got it. And I see here you have a slide on supermarkets, which reminds me I did want to talk to you about supermarkets, where we've seen a lot of disruption, less of course from the online, but more from Aldi coming in and really driving down price, and as you have up there, really taking share. Can you maybe update us about, I know you wrote a note on that about 6 months ago too, maybe what's gone on in the last 6 months, what you expect to happen going forward in the supermarket space?
Yeah, so I guess our supermarket thesis is a bit more simple than Amazon one. So what we're seeing here and what you can see on the chart is basically the growth, and these are our expectations. So the dotted line, the blue dotted line, that is where we think the grocery market, food and liquor, will grow in Australia as a whole. And then you can see Woolworths and Wesfarmers growth underneath the green and the red line, so pretty much in line with that growth. At the very top, we see Aldi. So it's outgrowing the two big incumbent players by magnitude, and we expect they will do that for a few more years to come as they aggressively continue to roll out their store network. So given that the grocery industry itself is a mature industry with, as we can see, 3 to 4% growth per annum over the longer term, if they want to grow, they need to grow or make sure they at least maintain their market share. So limited top line growth, they want to make sure they keep their market share and protect that. And I guess in a highly commoditized market or industry such as groceries, the best differentiator is really price. So due to that growth, due to the threat to the market share, we see players continuing to cut prices. And that, in our view, will bring EBIT margins even lower. And we think even EBIT margins in the supermarket space in Australia will excuse me, I just cut out, will be similar to what we see globally. So our analysis shows that on the global average, the average grocery store around the world has an EBIT margin of about 4%. That means they have sustainable, long-term, profitable businesses. And in our view, that's where we're seeing Woolworths and Coles both heading. And given the evidence that we've seen in the last 6 months since we've refreshed our thesis and published that report, we really found, yes, price cutting continues. Coles just admitted that quarterly, yes, we cut significantly our prices in the first quarter, and we're going to continue to do so currently. Aldi was quoted, or the CEO of Aldi was quoted in the newspaper earlier this week, also saying, yes, we are cutting prices. We have to be the lowest pricing point for the consumer out there. So in our view, our thesis is still playing out, and we expect at their next financial results we'll probably see another hit to margins in the supermarket business, unfortunately. So I guess to summarize, both Woolworths and Wesfarmers at these price levels we view it overvalued. And we just believe that the market is probably a bit more optimistic when it comes to EBIT margins and probably even implicitly factors in some growth there, which we can't see happening in this competitive environment.
Sure. So you think the supermarkets look a little bit overvalued? I know you said you think Harvey Norman looks a little bit overvalued. Maybe coming back, David, when you're talking about the banks, you talk about the potential hit if they're not able to recoup some of those costs of 3 to 5%. Where does the valuation on the banks, as you see it, square up versus the market right now?
Sure. Well, of the four major banks, ANZ and NAB are trading around about our fair values now. CBA is about 5%, 6% below, and Westpac's about 10% below. Of course, Westpac went ex today, so it'll probably be maybe 12% below fair value today. So we've held our fair values broadly stable over the last 12 months or so, and we've seen over the last 4 months, 6 months, we've seen a strong recovery in share prices up to our fair values and actually above our fair values. But of course, the pullback we've seen over the last 2 weeks has brought them back broadly in line to a little bit undervalued.
Sure. And Brian, I know you mentioned the potential for Vocus. Is that your favorite name on your coverage list right now?
It's by far the name with the highest upside on a long-term view. Otherwise, most of my stocks are trading in that 3-star territory, which under the old parlance would be holds. But even within that, I know the market is down quite a bit today, and even within that, there are some interesting stories. For example, I believe News Corporation is looking interesting, trading at around about 15% discount to our $21 fair value. Now, you're probably sitting there thinking, didn't you just tell me that these media companies have structural issues? Isn't that what you just said, Brian? Well, that is true, except that newspapers is only about 40% of News Corporation's earnings. And most of you will know that News Corp actually controls REA Group, which operates reestate.com.au. And the company is also trying to establish a similar kind of company in the US with a company called The Move. And finally, there are some cost-cutting potential with this company because did you know that News Corporation's overhead cost base is $180 million US? $180 million. I mean, that's a lot of people doing I don't know what in the head office, and I think there is room to cut that. So,
great. Well, I think there's some microphones available, so we've got some time for Q&A. We'd be happy to dive into any topics you'd like more deeply.
Thank you for the presentation. It was, each of you were quite bleak in the picture that you actually spoke about. Do you envisage a time beyond Amazon and Google perhaps that will actually perform other businesses? If you look 10 years down the line, what will the top 10 stocks look like? People are going to be losing jobs, cost cutting, but it sounds like News Corp, their online will give them a saving grace or a bit of a life raft. So what's each of you, I suppose, in the banking sector, retail, what did they say, the recession of retailers, and technology, are you just going to own Amazon, Google, and those likes?
Well, sorry.
Yeah, go ahead, Alex.
Perhaps I'll kick it off. So I guess one company that comes to mind is Domino's Pizza. I guess I like companies where it's impossible to offshore their business. You know, you can't bake a pizza in China or in Southeast Asia somewhere and ship it to Australia. So it's impossible to do so. Childcare is another example. So you can't offshore that. And talking about the online disruption and how important it is to grow the online channel, and they are really the leader there. So the majority of their orders are online. So they're really embracing that technology. And also they've, with their store footprint and that they need to be in those areas within a certain, catchment to own that or to be able to deliver and fulfill on their orders. I think that's a business model that is still viable for the longer term and is unlikely to be disrupted by Amazon or by, cheaper labor offshore.
And just on the banks, in my view of 10 years' time, or approximately there, I'd see some of the bank revenues being competed away and taken by some of the large competitor disruptors. But I think the banks, and I was trying to get this across, the banks have been masters at adopting and applying technology to reduce costs. So whilst I see some lower revenue growth, I see good upside in lower cost growth and hence bottom line, modest to reasonably good bottom line profitability. So as long as the economy holds together, and that's the big if for the major banks, because they're obviously such large parts of the economy. If the economy holds together, if we don't have a major recession, the banks will keep growing. Credit growth will probably slow a bit, but the focus on productivity improvement, so lower cost growth, should see reasonable profit growth and modest dividend growth.
Yeah, in my sectors, I think it's working. In my sectors, I think companies will survive, otherwise our fair value would be zero. But I think these companies will need to change and evolve. So I do believe looking 5 to 10 years out, there might only be 2 media companies, maybe 3, and I could be out of a job. But I think media cost base has to readjust, and everybody's got to suffer along the value chain. So you look at AFL League, how much they get in terms of broadcasting rights, and that will have to adjust, and these footballers need to be paid less. And I think cost base will need to be amortized over a large audience base. And I believe subscription-based revenues will overtake advertising-based revenues going forward. You just need to make consumers pay. And the problem right now that all media companies are trying to figure out is how do we make consumers pay? Because, you know, we're trying to force them to pay, but none of them will pay. And did you know that you can get into Sydney Morning Herald even though it's behind the paywall? Actually, maybe I shouldn't say this, but even though it's behind the paywall, if you go to Chrome and go under incognito, you can access any content that you want. Now, do you think that Fairfax doesn't know that? No, of course they know that, but how do you fix it? Well, that's the whole dilemma that we're in. And, you know, I write my research, but, you know, McKinsey charges $10,000 for that piece of advice just then. And so in the meantime, I think there will be a lot of thinking, a lot of business model restructuring and reconfiguring. And yeah, and then it might need to be some private equity ownership to take these companies off the public eye and do this business model transitioning. That might be the case in the near term.
Thanks, great question. Any other questions?
Hi guys, Anthony Sohan, Morningstar. This is not a planted question. Brian, just when you were talking about TPG coming, is part of that that $25 billion of revenue, are they after the margin that's there, or are they also seeing growth in that segment? And David, if you were to say, what are maybe 2 things that would possibly put the moat rating on the banks on negative watch, or what do you, if there's 2 things that would make you stand up and really think about that rating, what would they be?
Well, I'll start first. One of the 2 would be if there's an expectation that the current government or future governments would increase the levy further and the banks were unable to recoup the additional cost. So as I mentioned earlier, you know, my thesis for wide moats is based around pricing power. So if it's obvious that the bank's pricing power has been diminished, then there are additional increases in the bank levy, well, then that would put my wide economic moat thesis under pressure. The second thing, I suppose we haven't touched on housing today. Obviously the housing market in Australia is very topical and very important and very big. If I came to the conclusion that I thought the risks were just getting so high that I thought that there was a likelihood of a major house price crash, then that would have some bearing on my positive long-term view on the major banks.
Yeah, thanks, Anthony. David Teo, the executive chairman of TPG Telecom, I believe the way he thinks is this $25 billion revenue too, I don't think it's going to grow that much, maybe 2% every year. What I want to focus on is that $8 billion EBITDA pool, that 30-odd% margin that the three snouts are generating at the moment. And he's looking at that and he's going, look, 30-odd%, no, I want to have a piece of that. And I think I can because I've got the back office and the infrastructure already in place in terms of the wholesale fibre footprint. So I'm going to attack that $8 billion profit pool. And even if I get 10% of that, that's $800 million. And even if my entry lowest industry EBITDA margin and that 800 million becomes 500 or 600 million, because my initial entry cost is about 2 billion, I can still make a good return of that. I think that's the way he thinks, and that's his motivation. And because the way he thinks is, why should Telstra own 41% EBITDA margin on its mobile business? Why should Optus own 34% EBITDA margin on this business? And why the hell should Vodafone own whatever margin it gets? Who knows? But I want a piece of that, and that's the way he's operating.
I think we probably have time for one more question. Back here.
I think there might be two questions, but I'll be quick. There's an elephant in the room here that I've noticed for quite a while. It's the foreign tax that domestic players pay versus the domestic companies. So roughly 10% withholding tax on Aldi. Woolworths pays 30%, 28%. As an example, is there any likelihood that the playing field will be levelled at any stage in the next 100 years? Because it hasn't been up to date. And I think it's ridiculous.
Yeah, well,
anyone can comment.
Yeah, let me start. I mean, obviously the major banks are an easy target, and certainly a popular punching bag in Australia. And whilst I thought the bank levy was bad policy, it was certainly good politics. And it was easy for the government to implement it. Whereas what you were suggesting, implementing an effective, and I stress effective, 30% tax rate on some of these big foreign players that we have in Australia is a lot harder, and there's a lot of consequences to the government doing that, and it's a shame, but it's just a fact of life, I think.
Johannes, I don't know if you had any thoughts on that from the retail standpoint?
Well, I guess, in terms of a level playing field, it'd be great to have that. Question is, and I'm probably on the same page as David. Will we see that, and how easy is that to unwind and implement? But yeah, is it unfair that Apple's not paying any tax, so to speak, in Australia? Probably not, right? So, I don't have a view if that will change anytime soon.
I think we are probably about out of time. Was there one more? Yep.
I'm going to quickly get the microphone to you.
Thank you. I think the answer to the foreign tax question is just to increase GST to 15%, and that's an easy decision the government could make. But my question is to Brian about Vocus. Vocus has, had a difficult period, but Brian, you're very confident that the value is twice. What have you been told by Vocus current management that they're going to do different to bring together the businesses that they've cobbled to provide the accurate information to the driver? That we don't know.
That's actually a very good question, and I should preface all this by saying that I have not been given any extra information by management. What has happened and what has disappointed me, and I think it also disappointed management, is that in the process of trying to extract synergies from all their acquisition, that's when they realise that the systems and the processes and the controls are woefully inadequate. And what they're trying to do is, even though they are listed, they are trying to take a first ground principle in terms of fixing everything up from the ground up. So they've just got a new CFO who's working with the CEO. They are going to appoint a new transformation officer, and they are actually going to have an investor day next month to explain all of this. So no, they haven't told me anything special about how they're going to fix it, but they are trying not to do a patchwork job just to appease the market at the moment. What they're trying to do is, look, our stock price is already trashed. Let's take this opportunity to do a first principle thing, work from the ground up, and let's fix this thing once and for all instead of trying to patch it and continuously disappoint. Now, if there is another profit warning coming, then it does raise the issue about whether the current management team is the right management team to fix this company, or whether you need a brand new management to come in and perhaps sell off some assets to give them a bit more breathing room.
So that's about all the time we have for questions. Thank you so much. I just wanted to really quickly touch on one last point that Heather Brilliant brought up this morning during her opening remarks around the global star ratings. So most of you are, I'm sure, familiar with how we rate our equity recommendations: buy, accumulate, hold, reduce, sell. Heather mentioned the potential to go to our global star rating, and I just want to highlight from our perspective, as it impacts us directly, there's really no real change on how we go about our day-to-day job, nor is there any real change on how those buckets are calculated. So there are 5 recommendations, again, buy, accumulate, hold, reduce, sell. There are 5 stars. And so globally, we use the same math and the same underlying research to reach a 5-star rating as we do for a buy and a 1-star rating as we do for a sell. And even if we end up going to a global system, that won't change. And our focus on the underlying competitive advantages, the moat, and the fair value estimate, and comparing that to the market price to reach those recommendations won't change either. So I just wanted to comment on that from our perspective. I think Heather did a good job describing it, but happy to chat about that in more detail as well. So we do have an analyst table downstairs. We'll be there. Some of us will be there at lunch and during our second tea break, so feel free to stop by with more questions. But please join me in thanking our panelists for a terrific conversation. Thank you, guys.